Good afternoon and welcome to BizTech's Asian Midday Market Watch. It's Thursday, the 13th of July, and we have our regular guest, David Kuo, founder of The Smart Investor, coming to us out of Singapore. David, as always, great to have you on the show.
Selamat tengah hari, Brian.
Now, selamat tengah hari. Now, David, before we get your insights, let's take a look and see how markets across the region have performed. We're going to start with the crypto markets. Bitcoin is still at that 30,297 mark. It's down 1.09%. Ethereum is at 1,865. It's down 0.93%. Now, looking across to regional stock markets, we start first with the SGX, where you're at. The SGX is up a whopping 1.6%. Across the region, we've got the KLCI, which is up 0.01%. Shanghai is up 0.85%. The ASX All Ordinaries is up 1.53%. The Nikkei is up 1.39%. The Hang Seng is up 2.32%. And rounding up the numbers, we've got the Kospi, which is up 0.8%. Now, David, it's a sea of green, which is a stark contrast to our normal Thursday conversations. Tell us why.
Thank you for reminding me, Brian. Yeah, let me pinch myself. Yeah, is it really a Thursday? Yes, it is a Thursday. Yeah. And I think we can thank the inflation numbers from America for all of this. The American markets were up last night, and there was follow-through buying today. As far as a lot of people are concerned, when they have a look at those headline numbers, the headline inflation rate, 3% versus 4% last month. And then we have the core inflation rate, which is slightly more worrying. That's at 4.8%, and that compares to 5.3% the last time. So a lot of people are saying, is this the end? Is this the end of the rate hike cycle? And I think we have to defer to a quote by Winston Churchill, who said, this is not the end. This is not the beginning of the end. This is the end of the beginning. And I think effectively what people need to remind themselves is that inflation is not done, right? The Fed has not beaten inflation. Just look at those core inflation numbers, 4.8%, and the Fed target is 2%.
2%.
So it's about sort of twice what the Fed target rate is. And so as far as interest rates are concerned, I think we're going to see a rate hike this month. And some people are saying there could be another rate hike later on. But ultimately, the Fed will be very data dependent. So they will continually look at the data. And we got some producer price index numbers coming out at the end of this month. And so they'll be looking at those just to see how inflation is playing out. But it's going to be tough, but the market wants to believe, right? This is it. The mentality of the market is they want to believe that the rate hike cycle has ended, and they're trying to look through the fog of interest rate hikes and say things are going to be better. And so consequently, they're piling into the stock market. But what they forget, Brian, is that there is still this thing called quantitative tightening, which means that cash money is going to be withdrawn from the market in order for the Fed to shrink its balance sheet, which is overly bloated. And so they need to also consider how that will impact the availability of credit for companies that need it. And I think we are going to see an economic slowdown. Whether that will result in a recession is kind of arguable, but there's definitely going to be some kind of slowdown because that is what the Fed wants. Right? It wants a slowdown so that it can actually hit the wage inflation cycle on the head. It cannot allow people to say, oh, the core inflation rate is 4.8%, so therefore I want a 4.8 or maybe even a 5% pay rise. It's got to try and sort of stop that because otherwise inflation will just take off again, Brian.
Now, speaking of slowdown, we've had poor numbers out of China over the last couple of weeks. We also have poorer manufacturing numbers from the trading nations like Singapore and Germany in particular, which is a worrying thing as well. But then, David, on the flip side of it, we've got investors today piling into Chinese stocks. Now, what's fueling this optimism with China despite the poor economic data that's coming out of China over the last few weeks?
I think you have to put your shoes in, put your feet into the shoes of the Chinese authorities. And you have to ask yourself, where is the engine of growth going to come from as far as China is concerned? Is it going to be consumer spending? I think not, because I think the Chinese consumers, the Chinese households are very cautious, and they'll want to sort of keep every yuan they have just in case something goes wrong. Is it going to be exports? I don't think that's going to happen either, right? And so we know there is this trade war, in inverted commas, between the West and China. And so I don't think exports are going to be the main driver of growth for China. Then we have two other engines of growth. Public sector spending. I don't think the Chinese government or the Chinese banks have that much money available in order to drive economic growth. So we're left with one, private sector spending. And the Chinese authorities shot themselves in the foot a couple of years back when the only engine of when the biggest engine of growth they had was the tech companies. And what did they do? They had this crackdown on tech companies, slamming companies such as Tencent and Alibaba and Pinduoduo and the rest of them. And then now I think they're having a bit of regret. And they're thinking, okay, let's adopt a lighter touch on these tech companies and try and get them to drive economic growth. But the problem, Brian, is as somebody who is very familiar with engineering and cars, Brian, you know that if you have a car and you take out the carburetor, the car's not going to run, right?
Yes.
And I think it is the same situation here. They have clipped the wings of these companies for political reasons, not for commercial or economic reasons. They clipped the wings of companies like Alibaba, broken it up, in other words, remove the carburetor from the engine. And then now they say, oh, Alibaba will be able to grow again and hold the Chinese economy out of the economic doldrums. It's not going to happen, Brian. But people, again, want to believe that the 8 separate companies in Alibaba will be as good as the one single entity where there was interactions between the various parts of Alibaba. I don't think that's going to happen. So I hope, companies like Alibaba and Tencent will be able to go back to what they were before, and that you'll have 8 large companies rather than one huge company previously. But I think that's wishful thinking, Brian. But maybe the Chinese authorities believe in wishful thinking.
Now, then closer to home, the data, economic data out of Malaysia has been good. We're just around the corner from state elections in Malaysia. Through your investor lens, what do you see and what is your outlook for the Malaysian economy?
It looks promising to me, Brian. I mean, we have to start at the beginning of the month when Bank Negara Malaysia kept interest rates on hold at 3%, and they said they want to be as accommodative and as supportive as possible for the Malaysian economy. They also believe that inflation is going to be heading lower. We'll find out at the end of this month whether that is going to be true or not. And then we have the employment data, which is strong. So it therefore means that more people are in work. So it means that more people have money in their pockets to go out and spend. But the worrying thing was one number that came out today, which was retail sales. And whilst there was still sales growth of 5% compared to a year ago, it is definitely slower than what it was after the pandemic, after the reopening of the Malaysian economy, when we had this revenge spending. And a lot of people had a lot of ammunition, a lot of money in their pockets that they couldn't spend when they were locked down, but they then were able to sort of spend after the lockdown eased. And so I think we're going to see that consumer growth is going to be okay. It's not going to be fabulous. Industrial production is one. We saw actually some good industrial production numbers today, up 4.7%, which was a reversal of last month. So I think, on balance, if you asked me, would I put my money in China or would I put my money in Malaysia? I would say, with one caveat, Brian, I would put my money in Malaysia because I think the consumers are there. I think private sector spending is there. I think there is going to be some government spending. And I think the export numbers, which will also come out at the end of this month, are going to be strong. So I think the 4 levers or the 4 engines of growth in Malaysia are in place. The caveat being the Malaysian ringgit.
That's right. I was just going to ask you about that because the spread between the ringgit and the US dollar return is about 2%, if I'm not mistaken.
Yeah, I know. Yeah, and that was my one caveat, and that is one thing that people outside of Malaysia will, of course, be thinking. Oh, David, it's great, you know. I mean, if I make 5% or whatever, you know, on my investments in Malaysia, but then when I convert it back into Sing dollars, well, and you know that 5% has just evaporated, so therefore I've made nothing at all. But my mantra has always been: there are some things you can control, some things you can't. Right? You can control the companies that you put your money into. In other words, you can choose the best companies in Malaysia to put your money into, and hopefully that company will be able to grow its profits and grow its payout, grow its dividends for you. That part you can control. The currency, on the other hand, you cannot control. You have no control over the currency, the exchange rate between the Malaysian ringgit and the US dollar or the Sing dollar. So it depends whether or not you put any store into exchange rates. If you don't, then of course I would say that Malaysia has all the ingredients in place for strong economic growth and also for those companies that are listed on the Malaysian market. The good ones will continue to be good, and in fact, they'll be better in a year's time than now. But if you ask me, Brian, what will be the exchange rate between the Malaysian ringgit and the Sing dollar in a year's time? I have to honestly say, I have no idea, Brian.
On that note, and on that very pragmatic note, thank you very much for your insights, David. Thanks for coming on the show.
Thank you.
I'm Brian Fernandez, and we've been speaking to David Kuo, founder of the Smart Investor out of Singapore, on BizTech's Asian Midday Market Watch. This interview will be on our website, www.biztech.asia, as well as our syndication partners, TV stations, radio stations, and websites. Thanks a lot for tuning in.